A price doesn't usually speak for itself, but today, gold's price says everything. $4,057 per ounce. Down just 0.5% on the day, but up so massively over the past 2 years that is forcing everyone, from the Federal Reserve to global hedge funds, to reconsider the role of gold in a world reshaped by inflation, geopolitical fragmentation, and declining trust in fiat currencies.
And what's striking is that gold isn't behaving the way it used to. Historically, gold surged during crises, then cooled off when the Fed tightened monetary policy. That relationship is breaking down. Even after the Fed's aggressive tightening cycle, even after real yields climbed higher, gold refused to fall below its long-term structural floor. It didn't just hold, it soared.
Exactly. And this shift, according to macro investors like Ray Dalio, signals something larger than a normal cycle. Dalio has been very clear. The global order is changing. The US and China are in a deepening strategic rivalry, debt levels are historically high, and fiat currencies are under pressure. In Dalio's framework, gold becomes the asset that sits outside the fragile system. It becomes trusted when trust in governments and institutions erodes.
Which makes today such a pivotal moment. Gold at $4,057 isn't just another number on a chart. It represents a fundamental reevaluation of risk across the world. And the big question is whether the Federal Reserve will push gold even higher, depending on what it does next with interest rates, inflation management, and liquidity injections.
Let's dive into that, starting with what gold's movement is telling us right now. The pullback today, just negative 0.55%, isn't weakness, it's consolidation. Gold has been climbing so rapidly that even a 1% dip looks like the market taking a breath, and the underlying demand from central banks is still relentless.
Central bank demand is the hidden engine of this rally. The World Gold Council has repeatedly confirmed that global central banks are buying gold at the fastest sustained pace in more than 50 years. China, India, Singapore, Turkey, Saudi Arabia, they're all diversifying away from U.S. treasuries. The People's Bank of China alone has added massive amounts of gold to its reserves since 2022.
And the geopolitical dimension is impossible to ignore. Countries that fear sanctions, currency weaponization, or dollar-based constraints are shifting into gold. This was something Zoltan Pozsar predicted years ago, that geopolitical fragmentation would drive a multipolar, commodity-backed reserve system.
So here we are, sitting at the edge of a potential monetary realignment. But to understand where gold is heading next, we have to examine the role of the Federal Reserve, because whatever the Fed does next could determine whether gold just consolidates or explodes even higher.
Right now, markets expect the Fed to cut rates. Inflation is sticky, but slowing. But the deeper issue isn't the short-term inflation number, it's the long-term credibility of monetary policy. Investors like Stanley Druckenmiller have said repeatedly that the US is trapped by its own debt. The government cannot afford long periods of high interest rates.
And that's where gold comes in. If the Fed cuts too early, gold surges. If the Fed cuts too late, gold still surges. If the Fed restarts quantitative easing during a recession, gold goes vertical. The only scenario where gold could face meaningful downward pressure is if the Fed suddenly adopted a Paul Volcker-style approach: extreme tightening, aggressive rate hikes, and a sincere commitment to crushing inflation.
But Volcker had something Jerome Powell doesn't: manageable government debt. In the 1980s, the U.S. debt load was tiny relative to GDP. Today, the U.S. debt load is so large that even a small increase in interest rates sends borrowing costs skyrocketing. This creates what Druckenmiller described as a no-win situation for the Fed. Any path they take leads to either financial instability or inflation, and in a no-win environment, gold becomes the easy winner.
Let's talk about inflation, because it's more complicated than the headlines suggest. The official inflation numbers have come down, sure, but the underlying structural inflation, energy, wages, housing, remains elevated. Investors like Jeff Gundlach and Howard Marks have been saying that inflation is no longer transitory or temporary. It's a long-term structural force.
Marx said something extremely important. We are entering a new environment where cheap money is gone. Rates may not stay as high as today, but they won't return to the near-zero era. That structural shift alone is enough to keep gold in an upward trend, because gold behaves best in environments where real yields are unpredictable and confidence in fiat money is unstable. And let's not forget the psychological element. When gold crosses major round numbers, 2,000, 3,000, 4,000, it creates narrative momentum. We're not talking about short-term traders here. We're talking about pension funds, sovereign wealth funds, and family offices that see gold as a long-term hedge against systemic risk.
And the broader market is reacting the same way. The equity markets feel fragile, bond markets feel manipulated, housing is unaffordable, and digital assets, while growing in influence, remain highly volatile. Gold becomes the anchor asset for a world with too much uncertainty.
That brings us to a fascinating point. For the first time, gold and Bitcoin are rising together. Investors like Michael Saylor have been very vocal that Bitcoin is digital gold, while gold remains the historic and institutional store of value. The fact that both are climbing tells us the issue isn't about choosing one or the other. It's about escaping fiat erosion.
Exactly. Bitcoin appeals to the high volatility, high conviction investors. Gold appeals to the institutional and sovereign investors, but both respond to the same macro forces: inflation, monetary debasement, and geopolitical risk.
So here we are. Gold is consolidating at $4,057. The Fed is under pressure, inflation is structurally embedded, central banks are stockpiling gold, and investors across the world are looking for the next major move.
And that's what we're going to explore in part 2, whether gold is preparing for a breakout, a correction, or a period of sideways consolidation, and what the biggest investors in the world are predicting about the next 6 to 12 months. Picking up right where we left off, gold at $4,057 per ounce, consolidating after a massive rally. The key question now, is gold preparing for its next leg upward?
And a lot of top macro thinkers believe the answer is yes. Ray Dalio, for instance, has been very consistent in saying that we are entering a period of currency wars, where countries try to weaken their currencies to compete economically. When currencies weaken, gold strengthens.
Stanley Druckenmiller put it in simple terms. I bought gold because I don't trust the central banks. Coming from a man who has averaged returns of 30% for 3 decades, that's a powerful statement.
So what are the scenarios for gold from here? Let's lay them out clearly.
Scenario 1. The Fed cuts rates in 2025. Gold breaks above $4,200 and possibly heads toward $4,500 as liquidity increases and real yields fall.
And scenario 2. Inflation re-accelerates. This is the nightmare scenario for the Fed and the dream scenario for gold. If inflation rises and the Fed hesitates to raise rates again, gold skyrockets.
Scenario 3, a recession hits. This is where gold becomes the best performing asset in the world. During recessions with high debt, central banks inject liquidity, lower rates, and weaken currencies. Historically, gold performs extremely well during these windows.
And the fourth scenario, less discussed but important, a geopolitical shock. Anything involving major economies, US, China, Russia, the Middle East, can catapult gold instantly.
And central banks know this. That's why they're buying gold as fast as they are. They're preparing for a world where the US dollar is no longer the sole anchor of global trade.
So where does this leave us? Gold at $4,057 is not expensive relative to global money supply, global debt, or central bank balance sheets. If anything, gold is underpriced.
That's exactly what investors like Jim Rickards argue, that gold is still in the early stages of a long-term repricing cycle, where the metal adjusts to a world of permanently higher debt and permanently weaker fiat currencies.
And the charts support this. Every consolidation phase in the past 2 years has led to a breakout. Gold builds pressure, releases, then builds pressure again.
So the real question isn't whether gold has peaked. The real question is whether the conditions that brought gold to $4,000 are going away.
And the answer appears to be no. Inflation isn't going away. Debt isn't going away. geopolitical tensions aren't going away, and distrust in fiat systems is actually accelerating.
Which brings us to the conclusion. Gold isn't at the end of a cycle, it's at the turning point of a new one.
And in a world that's changing faster than anyone expected, gold remains what it has always been, the asset of last resort and the asset of the future.
Final summary. Gold is consolidating at $4,057 after a massive rally driven by central bank demand, inflation, geopolitical fragmentation, and declining trust in fiat currencies.
The Fed's next moves, rate cuts, liquidity injections, or policy hesitation could send gold sharply higher, especially in a world where uncertainty is the new normal.
Gold isn't reacting to the Fed, it's leading the macro narrative.
And that's why we're calling this moment what it truly is, a turning point.